Hey Chivis, I'm Ivy, and today we're talking about the hidden engine room where life insurance money funds century-long AI infrastructure debt. If you enjoy stories like this, hit the like button and subscribe if you haven't already. Let's go! In 2026, Alphabet will still owe money on a bond that does not come due until 2126. That is a century of debt backed by servers engineers expect to replace twice before the principal is halfway repaid. The question is not why a technology giant would borrow for 100 years. It is who would lend for that long, knowing the collateral ages in dog years. The answer is not a bank. It is the slowest, quietest, most locked-in money in finance. Premiums from life insurance and fixed annuities, capital that arrives every month and cannot be recalled. This is the story of how that permanent capital became the hidden engine room for the largest infrastructure build-out in history, and why the accounting for that bet is happening far from regulated balance sheets. Over the next 10 minutes, we will trace the flow of policyholder money into private credit, map where post-crisis guardrails end, and explain why opacity in long-dated infrastructure finance is hard to measure. We are not predicting a collapse, and we are not selling a trade. We are drawing a map of a boundary that most investors do not know exists. The central puzzle is duration mismatch taken to an extreme. A life insurer might owe steady returns for 30 years. A data center might last 15. Yet the bonds financing that center now stretch to 50, 70, and 100 years. In theory, insurers match long liabilities with long assets. In practice, the assets are illiquid, privately negotiated, and backed by collateral that depreciates faster than the debt matures. When the same corporate family originates the loan, buys the loan, and moves the liability offshore, traditional checks dissolve. The question is not whether the technology will work. It is whether the financial plumbing is transparent enough to price the risk accurately. Act 1. The Duration Mirage. Let's start with the building. A modern artificial intelligence training facility is a power plant attached to a server farm, drawing more electricity than a mid-sized city. Hardware becomes obsolete in 3 to 5 years. Yet financing often carries maturities far beyond that economic life. Technology companies have issued century bonds and signed long-term lease commitments that, in aggregate, exceed $1 trillion. A material slice is structured as operating leases, so they do not appear as debt on the corporate balance sheet. Instead, they sit in special purpose vehicles and private credit funds. The investor is typically an insurer or annuity provider that needs to park money for decades. The mirage is prudent duration matching. The reality is that one side is lending for longer than the asset will generate reliable cash flows, while the other books yields based on models that assume lease payments are immutable. If technology shifts, the building does not become standard real estate. It becomes a stranded asset with a use case that may not transfer. Act 2. The post-crisis boundary. After the 2008 crisis, regulators rewrote securitization rules. Congress and the Securities and Exchange Commission created two safeguards. Regulation AB required granular disclosure for asset-backed securities. Regulation RR required sponsors to retain at least 5% of credit risk. These rules apply to instruments legally classified as asset-backed securities. But SEC staff have clarified that certain vehicles backed by physical infrastructure, specifically data centers and associated long-term leases, may fall outside that definition. A data center is real property, not a self-liquidating financial receivable like a mortgage. Because the collateral is a building rather than a pool of debt contracts, the instrument may not be subject to Regulation AB or Regulation RR. This is not necessarily regulatory capture. It is a legal distinction. The issue is scale. When hundreds of billions in infrastructure finance move through structures never designed for physical collateral, the exemption that made sense for a small project finance deal may not make sense for a sectoral build-out. The guardrails were built for mortgage-backed securities, not server farms. Act 3. Permanent capital and structural tension. Over the past 15 years, private equity underwent a quiet metamorphosis. Firms that once did leveraged buyouts began acquiring life insurance and annuity platforms. Public filings show that private equity-affiliated insurers now control material portions of the United States life market, with aggregate assets in the hundreds of billions. A traditional private equity fund has a 10-year lifespan. Insurance float is different. Premiums arrive monthly, must be invested, and cannot be withdrawn on demand. The industry calls this permanent capital. When the same parent owns both the originator of private credit and the insurance entity buying it, you get vertical integration. Apollo Global Management owns Athene. KKR owns Global Atlantic. Blackstone holds stakes in multiple insurers. These arrangements are legal and disclosed, but they create structural tension. The asset manager earns fees based on deal volume. The insurer owes policyholders a fixed return regardless of performance. When a loan moves from one pocket to the other, the fee collector and the risk bearer serve different masters. That is not fraud. It is a conflict of interest baked into the corporate architecture. Act 4. The Capital Conveyor. Now follow the money. A policyholder pays a premium to a life insurer. That insurer holds statutory reserves against future obligations. In the current structure, a growing share of those reserves flows to offshore reinsurers, with Bermuda as the dominant domicile. Data from the Bank for International Settlements and the National Association of Insurance Commissioners show a measurable increase over the past decade in United States life reserves ceded offshore. Offshore insurance is standard practice. The risk is not lawlessness. It is transparency and enforcement. Once offshore, reserves can be allocated to private credit funds within the same corporate family. Those funds lend to special purpose vehicles that own data centers. The vehicles collect lease payments from technology tenants, and cash flows back up the chain. The result is a conveyor belt that moves capital from policyholder through a regulated insurance shell, across an ocean, into a lightly regulated credit vehicle, and finally into concrete and silicon. At each point, accounting standards change, disclosure shifts, and the asset's price is set less by a market than by an internal model. Act 5. The Valuation Gap. Here is where the story splits. In Japan, the largest life insurers recently disclosed significant unrealized losses on domestic government bond holdings after the Bank of Japan exited negative interest rate policy in 2024. Those losses are visible because Japanese government bonds trade in liquid markets. The United States situation is different. American insurers heavily allocated to private credit whole loans that do not trade on any exchange. They are worth whatever the model says they are worth. That means the system lacks the early warning mechanism that Japan is experiencing. Japan is a controlled experiment in transparency. Rates rose, bond prices fell, losses appeared immediately. In the American private credit infrastructure complex, a comparable rise in rates or lease default might not show up with the same clarity. The asset could be carried at par for quarters while the tenant renegotiates. The gap between model value and recoverable value is the blind spot. To see where this might lead, look back to the late 1990s. Telecommunications firms laid millions of miles of fiber optic cable using long-term capital from pension funds, insurers, and specialty lenders. The infrastructure was real, demand projections were aggressive, and financing was non-bank. Many builders went bankrupt, yet there was no systemic banking crisis, because risk had migrated outside the depository system. Lenders took losses. The fiber remained in the ground and was bought for cents on the dollar by today's cloud giants. The analogy offers a template. The current AI build-out may produce credit losses in private portfolios without triggering a 2008-style contagion because the money is not on bank balance sheets. However, recovery values depend on alternative use. Fiber could carry new traffic. A hyper-specific data center with custom cooling may not convert to warehouse space, and the 90s build-out did not rely on state guarantee funds. Today, if an insurer fails, state guarantee associations cover qualified claims up to statutory limits, commonly $300,000 to $500,000 depending on the product and state. Those associations are funded by assessments on surviving insurers, and in some states those assessments are offset by premium tax credits, which can reduce general state revenue. The public exposure is residual. and capped, not infinite, but real. The systemic question may not be whether a bubble pops. It may be whether a prolonged period of opaque underwater duration mismatch slowly erodes the capital base that policyholders rely on, while regulators lack the granular data to measure the temperature. The structure we have described is not illegal, and it is not guaranteed to fail. Much of the debt is backstopped by long-term lease payments from investment-grade technology companies, a very different risk profile than subprime mortgages. Offshore reinsurance is standard, and guarantee funds impose real limits. But the opacity is genuine. The legal boundaries around physical asset securitization were not designed for a trillion-dollar infrastructure wave. When the same corporate family is on both sides of the loan, arm's length checks weaken. One idea to keep: distinguish between your federally governed retirement accounts and your state-regulated insurance products, which rely on a guarantee system built for individual failures, not concentrated exposure to one asset class. Ask where your annuity reserves are invested, and whether the issuer is affiliated with the asset manager originating the loans. If you found this map useful, subscribe for more evidence-based boundary drawings. We do not do predictions, and we do not do panic. We do context. See you in the next one.